The S&P 500 is down by almost 4% just within the past month. Some of the worst hit stocks are in the tech sector. My own portfolio is down by almost 4% just within the past month. Why is this happening? Are we due for a correction? Why are we having a downturn? What are the reasons behind it? And what am I, as a long-term investor, doing during this scenario? Those are the points that I will cover in this video. Please don't forget to like and subscribe. I upload videos on this channel every week. With that said, let's get right into it. The Federal Reserve during the past year has been buying up US Treasuries and mortgage-backed securities, $120 billion worth every month. They are buying these assets which are helping them keep the interest rates artificially low. $120 billion worth is being pumped into the economy. Now, when there is this much cash being pumped into the economy, everything gets expensive. That is why the stock prices are so expensive right now. Now, recently, the Fed has been talking about tapering, that is, reducing the amount of securities and treasuries that they're buying every month. When this happens, the cash in circulation in the economy will go down, and when that cash goes down, the price of stocks will go down as well. When they're dumping $120 billion worth of cash every month into the economy, most of this cash will find its way into the stock market, which keeps the stock prices higher. The Fed taper is the first reason that there can be a big correction upcoming in the markets, and that is what the market is pricing in. That is why we saw a downturn today. The second reason the markets are down today is because of the talks of increasing the interest rates. When interest rates are low, it is easier for businesses to borrow money at cheap prices and then use that money to invest in other things that helps them grow faster. When the interest rates become higher, the businesses that have a lot of debt on their balance sheet or the high growing businesses suffer because it becomes expensive to borrow money. The interest rate payments on that money gets expensive, and it is expensive to grow because they cannot borrow money that cheap to invest in growing opportunities. The companies that suffer the most during these times are the companies with a lot of debt on their balance sheets and the companies that are high growing companies. The companies with low amount of debt, growing revenues, come out as winners. Now, this is the second reason the markets are down today, and we could face a correction if the interest rates go up. The third reason the markets are down today is because of the overpriced S&P 500. The current P by E ratio of S&P 500 is 37.8. This is 91% above the modern era market average of 19.6, putting the current P by E 2.3 standard deviations above the modern era average. Whenever this happens, the market faces a downturn. This happened in 2009. This happened in 2001. Whenever this S&P 500 is this expensive, the market either crashes or it faces a downturn. And we are at all-time highs in the S&P 500 P by E ratios. Now, that is one of the main reasons that we are due for a correction. That suggests that we are due for a correction. And the market is down today because it is pricing that in. If the Fed tapers, if the interest rates go higher, the P by E ratios will come down because the market will correct itself, and the high-flying growing companies will face a correction. They will come down in prices. Anytime during the history the S&P 500 has been this high, it has come down either through a recession, either through a depression, either through whatever means. When the S&P 500 has been trading at such high P by E ratios, in one way or the other, it has found a way to come back down. And that is what it is looking like will happen this time around as well. If we look at the history, we can see that. The fourth reason the markets are down today is because of the approaching deadline for increasing the debt ceiling and the fear of default on our debt because of a dysfunctional government. Now, every year this political drama happens and they end up increasing the debt ceiling. You're raising it before the deadline, but there are some fears and the market is pricing that in. If US government fails to raise the debt ceiling, which is highly unlikely, but if it happens, it can very well lead to a collapse of the United States dollar and a collapse of the global financial economy. These are the four reasons the market is down today and why I think we are going to face a correction anytime soon. Number one is the Fed taper, when the Fed limits the amount of mortgage-backed securities and US Treasuries that they are buying, which reduces the amount of cash flow in the economy. The number second is increasing the interest rates. Number third is the all-time highs of the S&P 500. P by E ratio of S&P 500 companies is at an all-time high, and whenever this has happened in the history, the economy has faced a downturn. The markets have come down and there has been a correction. The fourth reason is the debt ceiling. The fear of the approaching deadline for the debt ceiling. Now, the real question is, what do investors, long-term investors like you and me, do in these situations? Should we buy? Should we sell? Should we just sit on the sidelines and enjoy the show? Or should we get out of the markets altogether? I am going to tell you what I am doing in this situation. Are you ready? I am buying great businesses with increasing revenue that have a huge moat around them, and I am buying them on their way down. Businesses like Facebook, businesses like Google, these businesses, their revenues are increasing upwards of more than 20% every year, and they have huge moats around them, and they have a strong balance sheet, and they have low debt on their hand. They have ultimate amount of cash on their hands. These are the type of businesses that I am buying during these situations. Some of the businesses that I'm not buying during this downturn are businesses like Shopify, businesses like Tesla, businesses that have their earnings 10 years, 20 years, 30 years, 40 years ahead, and businesses that are flying at an all-time highs, that have a P by E ratio of over 50 or over 100. These are the type of businesses that I'm avoiding right now because I think they will face a correction and all these businesses will come down to a stable price where the P by E ratios will be reasonable. I'm not saying it will be 20, it will be 10, but it will be reasonable, and it will be a good opportunity to build your positions in businesses like this. Businesses like Shopify, businesses like Tesla, and businesses like Etsy that have their earnings years ahead of them. Now, these businesses are very fast growing. They have a lot of increasing customer base. They are expanding very, very fast, but their P by E ratios, their prices are so high that it doesn't justify. And any common sense person will think that it will be a correction in these businesses if it happens. These businesses will be the biggest losers if a correction happens. Some of the other businesses that I'm not buying are Canadian Pacific. Canadian Pacific has a lot of debt on its balance sheet. Its amount of debt is almost equal to the amount of cash it has on hand, and that is a dangerous position to be in. I think its amount of debt is even more than the amount of cash it has on hand, and that is not a very stable position for any business to be in. And this is also a business that I'm avoiding right now buying anymore because of the debt that they have. The interest rates on that debt, if the interest rate goes up, the interest rate on that debt will eat into their profits, will eat into their bottom line, and will eat into their long-term profits and the amount of money that the shareholders can make from this business. Now, businesses that have a high P by E ratios, that are flying high, that have a P by E ratios above 100, that have their earnings way further into the future, and businesses that have a huge debt on their balance sheets. These are the type of businesses that I'm avoiding right now. While the other businesses that have a huge moat, strong balance sheets, great leadership, great products like Facebook, Google, businesses like 3M, these are the type of businesses that I'm doubling down on. I'm buying more. If they go down, I'll buy more. If they go even further, I will keep buying more. This is a great time to build your positions into companies like this when the markets are in a downturn. And if it goes down more and more and more, it will be a great time to build your positions into these companies. No matter what happens in the economy, no matter what goes on with the government, no matter what goes on with the Fed, businesses with increasing bottom line, top line, businesses with a huge moats around them, businesses with smart leaders, businesses with a strong balance sheet will continue to do better and will come out as winners in the long term. And that is what I'm buying right now. Some of the main businesses that I'm buying are Google, Facebook, Apple, JP Morgan and Chase, Realty Income Corp, 3M, Target, Duke Energy Corporation, Comcast. All these businesses, they have a lot of cash on their hands, they have low amount of debt, and they have a huge moat around them. No matter what happens in the economy, these businesses will win in the long term. Their revenues are increasing upwards of 20 to 30% every year. Both their top lines and bottom lines are growing. There is an increasing demand for their products in the market. These are the type of businesses that I'm buying. My favorite buy at this time is Facebook. I will be adding a lot of money to Facebook because my goal for Facebook, my end price of Facebook is somewhere upwards of $450. If you watch my videos, you know how bullish I am on Facebook. These are the type of businesses that I'm buying, and I'm not worried if the Fed tapers, if the interest rates go up, whatever happens in the economy. As long as I'm buying great businesses and I'm adding them to my portfolio, I really am not worried what goes on. I'm thinking long term, 5 years, 10 years out the line, and I will be a net buyer. If it goes down more, I will buy more. If it goes down even more, I'll buy more. If it goes down in a bear market for 5 years, 10 years, I'll still be buying businesses. Great businesses with great leadership, strong balance sheets, and strong moats around them. That is my strategy on how I am dealing with these news, these short-term fears, these short-term things that are going on in the market. Please let me know in the comments down below what you guys are doing. How are you guys dealing with these situations? How are you guys buying more businesses? What type of businesses you guys are buying? Please don't forget to like and subscribe. This is the Frugal Investor signing out.